This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So here we go, folks. Another brand new accounting standard and another standard that will be advanced a lot further when we get to strategic business reporting. But let's not worry about strategic business reporting for now. Let's just go through there and focus on what we need to know to be able to answer any questions that there may be in financial reporting. What it's all about, this standard, IAS 21, is all about your foreign currency. Now, you are an entity that will have its currency in which its financial statements are prepared in. So let's just say there that you are a UK-based company and you prepare your financial statements in pounds. Okay. Now, when you go through and enter into a transaction with a company based in the UK and get the invoice in pounds, there's no issues at all because you're going to debit your receivables, credit your sales, or debit purchases, credit payables with the figure that is on the invoice. Okay, it's the same currency. But what happens if you transact with a company overseas? So you're a British company and you enter into transactions, whether that's purchases, whether that's sales, with one of your European counterparts. All of a sudden there is that when you start looking at the sales and the purchases, so the debit to the receivables, the credit to the sales, or the debit to the purchases and the credit to the payable, you have an issue, don't we? And the issue there being that the amount on the invoice is recorded in euros and you need to convert that euro balance into your pound sterling balance. So we'll need to go through there and start again to look at those steps in terms of what do we look at the translation at initially, and then how do we go through there and look at our subsequent measurements, because that overseas balance may have changed either at the reporting date or when we go through there and enter into the final transaction. Okay, so receiving the cash from our overseas customer or making the payment to our overseas supplier. Okay, so that's the crux of the end of this chapter, being able to go through there and record those transactions in a foreign currency. To start off with, however, we need to go through and introduce what's referred to as the functional currency. Okay, now the functional currency, quite simply, is the currency that your financial statements are prepared in. Okay, so if you're a UK company, the likelihood is that your functional currency will be the pound sterling. Okay, but to you and I, okay, we need to make sure there that we are able to translate those overseas transactions into your functional currency, the currency in which the financial statements are prepared in. Okay, so in terms of the definition, we need to be able to make sure that we can identify what the functional currency is first. So if you like, the non-computational side of IAS 21. Well, the definition of the functional currency is the currency of the primary economic environment in which you operate. Okay, because if you're a business, you might be set up within the UK, but you might operate economically elsewhere within the world. Okay, so what you have to go through and do there is you need to look at where the company generates and expends cash, because where the vast majority of the company's cash is spent, where the vast majority of the company's cash is generated, is then the currency of that primary economic environment where you operate. Now, I always think that the best example is to take a country like Switzerland. It's in Europe, but the national currency of Switzerland is the Swiss franc. It is not the euro. Okay, it has it there as the Swiss franc. Now, the thing with Switzerland is it's right in the centre, in the heart of Europe, isn't it? It's surrounded by several different companies: France, Germany, Italy. My geography is not great, but I think that's roughly a few of the countries. But, you know, France, Germany, Italy all trade in the euro, don't they? Okay. So it could be that this Swiss company, even though it is operating or is based in Switzerland, it might have the euro as the functional currency. Why? Because that's the currency of the primary economic environment where it's operating. That's where it tends to go through there and generate cash from its sales and expend cash on its purchases. So you need to go through there and look at the currency that denominates the sales price. So yeah, you might sell some goods in Switzerland in Swiss francs, but maybe the vast majority of your trade is with companies in France, Germany, or Italy. Okay, so countries whereby you trade in euros. Again, your operating costs, you're looking there at your labor, you're looking at your materials. Again, you're likely to go through and pay your employees in Swiss francs. But it could be that maybe because your employees or some of them live just over the border in France, so you might be based in Geneva, which is very close to the French border. It might be there that you pay your employees in euros. It could be that a lot of your materials costs are goods that are imported from the rest of Europe and are therefore denominated in euros. Okay, so therefore, yeah, the majority of your costs, what influences your costs, is the euro as opposed to the Swiss franc. Okay, and then finally, at this level, we just need to look at what the finances are denominated in. How do you raise your finance? If you raise the majority of your finance in euros, again, it's pushing you towards the functional currency being the euro. If you go through there and raise your finance in Swiss francs, that's fine, but you would need to go through there and look at what you generate your sales in, what you expend your costs in, to further help you determine that functional currency. In the majority of cases, it tends to be that if you're based in a country, the functional currency is the same as that currency, but you just need to be careful whereby your primary economic environment where you operate is slightly different. Okay, so that goes through there and brings in this idea of the functional currency. Let's go through there and then think about the accounting. Okay, how do we go through there and account initially? How do we go through there and account for subsequently for these foreign transactions? Okay, because exchange rates move, don't they? They change on a daily basis. So therefore, if the exchange rates are changing on a daily basis, should we update the amounts that are there within our accounts? Okay. So if we go through there and think about what happens initially, if there is a transaction, then what you will go through and do there is you will go through there and record it at the exchange rate in place on the date the transaction occurs. So if you were to go through there and record a transaction within your accounts and converting it from the overseas currency into the functional currency, you would use today's exchange rate, which is referred to there as the historic rate. Okay, so nice and simple. Take the value on the invoice in the overseas currency and convert it using today's rates to get it into the functional currency. That's it. There's nothing challenging there, is there? It gets challenging as you then move on, because that's looking at everything when a transaction happens, what then happens subsequently. Okay. Well, what you need to be able to do is you then need to look at what happens at the reporting date. So at the reporting date, you need to identify all your assets and all your liabilities that are in a different currency to the functional currency. So all those balances that have required translating. And you need to go through there and identify and split them into monetary and non-monetary assets and liabilities. Okay, because the accounting treatment at the reporting date for each is different. Okay, so what we've got there is monetary items are items that can be readily converted into cash. Okay, so yeah, like that, they can be converted into cash. So what you're looking at here in terms of your monetary items would be things such as receivables, cash, overseas loans, and payables. Okay, they're at this level, they're the four common monetary items, receivables, cash, overseas loans, and payables. Okay, because they can be readily converted into cash. The key thing with your monetary items is that when you've identified them, because they can be readily converted into cash, that will mean that their value of being able to be converted into cash will change as the exchange rate changes. So what we go through and do there is monetary assets and liabilities are retranslated. They are retranslated at the closing rate, so abbreviated to CR for short. And then what happens there is that any gains or losses are recognized immediately through profit or loss. So if there's been increases and decreases in the value of the receivable or payable as you translate it at the reporting date at the closing rate, the gain or loss goes to profit or loss. Okay. Just note, just down at the bottom there, the standard doesn't specifically say much about where the gains or losses go, but it's usually taken that if it's a trading transaction, it goes into your operating costs. And then if it is a financing transaction, it goes into financing costs. So if there's a gain or loss on translation of the overseas loan, then that will be a financing transaction and go into financing costs. Anything to do with receivables, payables, that's part of your day-to-day trade, isn't it? So they will go through there, your operating costs. Okay. So we've explained what monetary items are. They are items that are readily exchangeable for cash. So what did we say were your receivables, cash, overseas loan, and payables? Okay. What do we mean by non-monetary? Non-monetary is effectively everything else. Okay. And to you or I, that's then in the statement of financial position is anything above your receivables balance. So inventory is non-monetary. It's not readily convertible into cash. You've then got your non-current assets. So maybe some investments. Maybe you have some property, plant and equipment. Maybe you have some intangibles. Okay. I think the key bit at this level, the non-monetary assets that you're likely to see are your inventory and property, plant and equipment. Once you've identified those non-monetary items, just be careful at the reporting date, they are not retranslated. Okay, so you leave them at what they were translated at the historic rate. You do not touch them. Okay, just note, and again, I think it's more an SBR perspective, strategic business reporting. Just note, unless it's carried at fair value, so your fair value being, say, under the revaluation model on IAS 16, then if you revalue it at the end of the year, then you would need to go through there and translate that fair value into the functional currency. Well, you will go through there and translate when the fair value was established. So if you do the revaluation at the end of the year, you will take that fair value and retranslate it at the end of the year rate. Okay, so that's likely to be seen if you've got property, plant and equipment that is held under the revaluation model and that asset is denominated in an overseas currency. So the fair value is calculated based upon overseas aspects. Okay, so yeah, I have seen that in SBR, or in the old days as it was P2, but I do just think it's a little bit too far-fetched to be appearing in financial reporting. But if it does, it will be tricky. If it does, you've got the notes there. Okay, so that's the standard, that's the background that we need to know. Just go back, have a quick read through it all, make sure that you're happy with it before we then go through the next video and have a play around with a question. I'll see you shortly.